All right. Well, hello, everybody. Thank you for joining us today for Trilogy's quarterly market commentary, the first one of 2026. Whether this is your first time joining or you're a regular attendee, we want to take a moment to welcome you and tell you thank you for your time. We appreciate you being here to hear what our Chief Investment Officer, Mike Serio, has to say today. A couple of quick notes. So, for the next 45-ish minutes, Mike is going to share some economic perspectives and market insights for you that will help connect the dots from the past, shed some light on what's going on right now, and help us navigate what's ahead. If you have any questions during the call, please email investment.team@trilogyfs.com. We'll put that email up toward the end as well so that you can see the email address, but please send any questions you have there, and we will make sure that we have a chance to answer them at the end of the call when we do our Q&A session. Before I turn it over to Mike, I will give you a little bit of an introduction. Mike Serio is the Chief Investment Officer of Trilogy Capital, and he's responsible for investment strategy and client communications. He oversees more than $4 billion in client assets here at Trilogy. He has over 30 years of Wall Street experience as a portfolio manager, strategist, and chief investment officer. Mike has been frequently quoted in the Wall Street Journal, the New York Times, Bloomberg, the Washington Post, and other publications. He worked on the Russian project for the United States Agency for International Development in the formation of capital markets in the former Soviet Union. He's also a former adjunct professor at the University of Denver and DePaul University. He earned his bachelor's degree in economics from the University of Illinois, an MBA in finance from DePaul University, and he has his CFA, which is a Chartered Financial Analyst credential or certification, and he's also a CAIA, which is a Chartered Alternative Investment Analyst. So lots of exciting things there and lots of wisdom. So we're looking forward to hearing, Mike, what you have to share with us today.
Great. Thank you, Caitlin. Let me share my screen here. First, beautiful. A lot going on. Some good news from 2025. Let's certainly start getting into this. And what do we want to talk about today? The first thing we'll do is a year in review. We'll talk about the stock market, the equity market. We'll go into fixed income. It was both a really good year for stocks and bonds in 2025. We'll get to a little bit of the alternative markets. That would be real estate, private credit et al., some private equity. We'll move into the macro comments. What's happening in the economy, what we want to see, what we'd like to see moving forward. We'll go through some of our opportunities in our tactical portfolio we see in 2026. And as Caitlin said, we'll certainly make enough time here for comments and questions. We'll have the email address again at the end, so you can email those in. That usually is the best way to do it. So how do we really capture what happened last year and what we've done? Well, a kind of a funny way to do this is a tale of how Wall Street says alpha generation through systemic factor exposure. That's actually what we do. When in reality, it really means we made money last year, and that's really good for our clients. That's really good for our business. I think this is one of those years where everybody's fairly happy about the results of the investment, of what we've been doing for clients, and it certainly gives us a lot of enjoyment to do it for all of you. So let's get into the equity market. Certainly after coming off last year's up 24% market, few would have had predicted we would have had a market that was up another 17.9%. That was just absolutely exceptional, especially in the face of what happened in April when we had the quote Liberation Day and the market was down almost 20%, almost a full-fledged bear market. I think intraday we had a bear market, but it didn't close to below 20%. So at the end of the day, we went through that. We kept our clients invested, and that led to some very attractive returns of almost 18%. Some of our, what we call our tactical overweights, where we thought there was opportunity there, worked out fairly well. Our communications exposure was up 33.6. Industrials were up 19.4. Utilities lagged a little bit, but we'll take up 16% for utilities. And some of the other things we've added include regional bank additions, which in the very short term has really done a good job for our performance. We will continue to believe in American exceptionalism, and hold full U.S. equity positions right now, although I'll talk about in a second how international markets had a very good year, uh, and we've certainly been able to participate in that. Growth, growth stocks, those companies that have the ability to grow their earnings faster than the overall market, continues to outperform value stocks. We still see significant concentration risk, though, in those stocks we refer to as the Magnificent Seven. I'll get into that in a second. Small caps and mid caps companies continue to lag. Those are the smaller companies of the United States, partly as structural with the advent of private equity taking hold of a lot of the better small cap opportunities. But this caused us earlier in the year to move to a more active value position in small cap and mid caps, having a manager come in and look at it more of as a bottom up investment than a top down investment. As I mentioned, international developed equities, which are concentrated in Europe, Australia, and the Far East, were up 31%. Part of that is the valuation gap between those stocks and US stocks. Those stocks had just gotten so cheap, but they had been cheap for a number of years, something like 10 years. They came back with a vengeance this year, up 31%, and we've had positions there. And for the first time in 35 years since I've been doing this, as Caitlin mentioned, over 30, Japan is now starting to look interesting, and we can talk about that towards the end if you'd like. Emerging markets, which are mostly dominated by India and China, were up about 34%, excuse me. Again, the valuation gap narrowed, but what worries us here in some of the emerging markets are the fundamentals, especially in China. China is still coming off their one-child policy, and that was instituted, I want to say, about 40 years ago. And frankly, they are just not organically growing. So you look at some of the problems there, those fundamentals continue to be weak. We still aren't putting a lot of our clients' money in emerging markets, but again, you want to be there because sometimes they will certainly surprise on the upside, which is what they did in 2025. Within bonds, broad market was up almost 8%, which is an extremely good market for bonds. Longer term, we try to squeeze out 4.5% from the fixed income market. Most of our bond market investing now is in active management using our two main firms. That would be Smith Capital Management and Wasmer Schroeder. Last year was the year of the commodities, and I'm sure you read about gold and silver. Gold was up 63% last year. Silver was also strong. Depending on how you measure it, was also up 100%. I'll talk a little bit about the commodity super cycle. It still seems early, and we are looking to take a more active view of commodities longer term. Private equity, debt, and real estate certainly underperformed the U.S. equities. It was hard to keep up with 18%. But longer term in those tactical portfolios where our clients do hold those private investments, we still think the diversification advantages over time will come out to be quite additive. And then finally, we do some custom structures here for those clients that did custom structures. They've really had some really good performance. Now let's get back to the macro part of equity investing. As I mentioned, the Magnificent Seven, those stocks comprised of Alphabet, which is the former Google, NVIDIA, Tesla, Microsoft, Meta, Apple, and Amazon had been leading the charge, and certainly for a good reason because they had been delivering on earnings for a long, long time here, 4, 5, 6 years, and they've been driving the market. But you can see in 2025, the Magnificent Seven did average 27.5% again versus the market 17, 18%. But you'll see that only two of those really outperform. That would be Google and NVIDIA. and the rest, Tesla to a certain extent, but the Metas, the Microsofts, the Apples, the Amazons actually underperformed. And what we're seeing is stock market returns broadening out to much more than this Magnificent Seven. And we've been able to take advantage of that with our large diversification between our stocks in the equity market. The other thing that dominated the news was tariffs. On the right side, one of our research partners looked at what are the actual tariffs we charge uh, countries that we trade with, and what are they charging us? And you can see to date why this administration has thought it was unfair, and it was quite unfair. So, on average, when we were importing things, um, some of the tariffs we were charging were only 3%, but if you look at some of our big trading partners, China, 7.5%, Brazil, 12%, and India, 16%, that's the tax they were charging on our goods and services being sold into their markets. And you can see it was certainly an unfair situation, which is what the administration wanted to remedy. And it looks like they've been somewhat successful at it, as quoted here by the New York Times just recently. Tariffs haven't had a bigger impact than everybody thought they were going to in the gloom and doom scenario. And steep import taxes have raised prices and affected U.S. businesses, certainly, but not quite as much as expected. Now, when we look at the trade situation, if you take a look at exports as a percent of GDP, not the market, I'm going to get into the market in a second, you'll see that the United States, we only rely about 11% of our GDP on things that we sell abroad. Other countries such as Germany, Mexico, Canada et al. Rely much more on us than we rely on them. Part of it is, again, is demographics. They are not growing their population. They are still producing things, and they absolutely need markets to sell into. And that's where we come in. We buy their stuff, and we're much more important to them on a trade wise than they are to us. Now, there's always unintended consequences here, and one of the unintended consequence of this tariff policy is a weak U.S. dollar. There's bad and there's good. Let's get to the bad first. Is you look at for those traveling maybe abroad this summer. If you're going to Italy, you're going to spend a little bit more for your Brunello, for your trip to the Vatican at all. It's going to make their goods and services that's much more expensive to us. But what it does on the other side is it makes our goods and services that much cheaper selling abroad. So there are benefits to having a high dollar, and there are, takeaways. But certainly one of the benefits here we're going to see is additional trade from U.S. goods and services abroad, and that's going to be an actual positive for our market. Now, I talked about trade being 11% of our economy. The economy sometimes is much different than the stock market, because when you look here, towards the bottom there, you're going to see the S&P 500, and this shows the mix of where the revenue comes from. As it says above, the international revenue is in gray. The domestic revenue is in blue, and you'll see kind of down there towards the bottom, the S&P 500, about 41% of companies in our U.S. stock market, about 41% of their sales do come from non-U.S. sources. So when you do have a weaker dollar, that's going to be positive for some of the sectors such as technology, materials, communications, discretionary et al. Some of those things that we are taking advantage of in our portfolios to look at a weaker dollar. Okay, let's get into some of the macro comments and get away from the equity market just for a second. This looks a little convoluted. I'll go through it fairly quick. But GDP, that's gross domestic product. That's how we measure our economy. We haven't had the final print on 2025 numbers yet, but it's looking that we grew about 2%, which given the environment we were in is actually pretty good. And the estimates next year, which sometimes are somewhat inaccurate. I'm going to show you how inaccurate they can be in a bit. But we're estimated at 2.4% in 2026. what the government wants us to do is to get to what we think we can do, and that's 3%. And once our economy starts growing at 3%, that means more than just bigger TVs and things like that. That means better education. That means a lot better life than what we know it. So we're looking for some positive things there. And again, we have to separate the economy from the market. That could translate into 15% earnings growth for the stock market in 2026. I'll show you that in a second. Some of the rules that were recently passed is due to change in expensing regulations. Capital expenditures, or what companies reinvest in their property, plant, and equipment, look to rise materially. So what does that do? Well, as we think more and more things are being produced here, it's going to take capital expenditures to invest back in the United States. And again, in that property, plant, and equipment. And if they have changed the accounting regulations because it's expensing and not capitalized, we won't get into the details there. It makes it much more attractive to invest in U.S. companies, which is one of the reasons for our overweight in industrials here. Another thing that's coming up are record tax refunds. We've had some of the tax laws changes, but we haven't changed the withholding. I'm going to show you, we're going to have record tax refunds. And the other thing we're looking at, believe it or not, is an increase in consumer spending, partly because we are hosting the World Cup next year. And people ask me, is this material? Does this move the needle? Absolutely. You look at I think it's going to be the first week in February this year. The Super Bowl is going to be, the viewership of the Super Bowl at a record was 202 million in 2024. The World Cup final was about 7 times as high, with 1.5 billion people watching the World Cup final. And with us hosting the World Cup, the amount of money that's going to generate from people coming into our country and spending to see the World Cup is really going to move the needle this year. We're going to have potential lower interest rates through Fed policy. I'll talk about that. We've got a change in banking regulations to free up capital. That is going to be good. That's going to decrease the amount people pay in mortgage interest. That should be good for the housing market. And then we also have to look at possible risks. And every year I've been doing this, there's always geopolitical risks, which are very difficult to forecast. What's happening in Iran, what's happened in Venezuela. Difficult to really quantify what that's going to do for our market, but we're always keep an eye on that. There's going to be a high earnings bar for those technology companies I talked about, the Magnificent Seven and others. They keep producing some great earnings, but as you know, success begets success. But the problem is you're raising the hurdle rate every quarter, so we're looking at that. We're looking at AI productivity, and hopefully that'll pan out. I'll show you where it's starting to pan out. And then obviously government spending that sometimes gets out of hand. We'll talk about that in a second also. But let's get to S&P 500 earnings here. You'll see where we are on the estimates going forward to 2026. And these are year over year on a quarterly basis. So we're looking at quarter one, quarter two doing about 12%, quarter three a little higher than that, and then quarter four in 2026 rising potentially 16.5%. Now this is on an earnings basis. But I tell you what, if those estimates do pan out, we should have some fairly attractive equity returns next year. I don't know if they'll be as attractive as they were in 24 and 25, but that continues to tell us we want to be fully invested within the equity market. I talked about tax refunds. Here's a way to quantify those, as we're looking at about $517 billion of tax refunds. And what we've known and what we've seen through the years is that most of that money gets spent, and people don't necessarily, when they get a big tax refund, save it. And given that 70% of our economy is consumer spending, that should go through the retail and consumer discretionary at all. And that causes, again, to have a slight overweight in consumer discretionary stocks. I talked about government spending. We always like to look at the government balance sheet. And this looks at the government balance sheet and really gives us an idea of how they are borrowing on a time frame. Just to put this in perspective, if we were talking, I don't know, 4 or 5 years ago when we had 3.5% mortgage rates, we were telling clients probably the best deal right now is to borrow money. As we're seeing those people with those mortgage rates, myself included, who has a 3% mortgage rate on a piece of property, it's very difficult to get rid of those. So part of it is what you are borrowing at on a percentage terms. And the second thing is how far you're going out to borrow it. Now, what we're seeing here is towards the left of the chart, over 50% of government debt is becoming due within 3 years. And this is why the administration has an incentive to keep interest rates low, because if the government rolls over this debt at higher and higher rates, what's going to happen is the servicing cost on this debt, actually right now it actually is larger than our defense spending, but you'll see that gets that much more to service that debt. So the government does have an incentive to keep interest rates low. You'll see farther out, 7 to 10 year, 10 to 20, and 20 plus year, a smaller amount of debt is out there. And what might happen, and as this plays out over the year, is that the government keeps interest rate low. They roll over that debt at longer and longer maturities, and that should be better for taxpayers and better for the bond market longer term going forward. Now, what are some of our investment themes going forward? The first one is continued deglobalization. We are going to continue to buy less and less from abroad. We are going to produce more and more at home, which again will cause us to invest more in property, plant, and equipment in the United States. Artificial intelligence, I'm going to show you how important that is. It's going to create efficiencies and investment opportunities, not just for capital expenditures in AI, but eventually all these companies that are investing AI are going to have to make some money on it. And I'll show you how that's kind of starting to go the right way. Power generation, we've talked about this in last quarterly meetings, that a ChatGPT search takes about 10 times the amount of energy as a Google search. And for the first time in my career, we're seeing utilities as actually much more than just a high dividend, low volatility play in the stock market, but for a business case to own utilities. And again, as I mentioned, we did fairly well in those last year. We're going to see that consumer spending wave we talked about, the broadening of earnings and market leadership. It's not just going to be the Magnificent Seven and the other 493 companies, but we're looking for some of those on the top tier to again grow their earnings in a fairly attractive way. The commodity super cycle is still early in precious metal and utilities. I'll talk about that. And again, we'll go through our overweights in industrials, financials, consumer discretionary, and again, utilities, which are finding us pretty attractive right now. Now, over long periods of time, what's important in some short cycle industries, short cycle would be technology. You may know, if you ever studied this, that a technology company will come up with a killer application. If that killer application lasts 2, 3 years, that would be great. But the problem is with technology companies over long periods of time, they have to reinvent themselves over and over and over again. Now, what we're seeing here is technology expenditures. We're seeing a record level investment in technology. So the companies we are investing in right now are not only those companies that are being used to increase opportunities in technology, but eventually those companies that are going to take advantage of this technological revolution. On the other hand, you have long cycle businesses such as commodities. So if you look as the world continues to grow, we're going to need more and more copper. The problem is with copper and copper mining, number one, besides it's being quite dirty and nobody wants it in their backyard, it takes about 15 years from a plan of a copper mine to it actually producing copper. So this creates very long, what we call long super cycles within the copper business. So what we're seeing right now is a very low level of investment leading to higher commodity prices, which is causing us now in our investment committee meetings to look at actively managed precious metals and industrials within the commodity area. Now, longer term, you'll see they have super cycles in these commodity cycles. And this goes back all the way to 1910. So the way a super cycle works is there's a shortage of these commodities. Companies come in, they have that long cycle to create mines, and mines are not just copper these days, it's lithium and it's rare earths, but it takes a long time for those mines to come online. In the meantime, prices of those commodities start rising because of the shortages. You'll see that happen in 1920, 1950, 1980, and the last one ending in 2010, where there wasn't much capacity out there. Prices rose, and then what happens is the free market figures this out. New capacity comes down, prices come down, and we start all over again. But you can see right there, we are in what I believe is about the third inning of this long wave of commodity price hikes. And so again, within our tactical portfolios, we're looking for additional ways to invest in commodities, both precious metals and industrials. The other thing, people have been asking about gold. Part of this is number one is some type of fear out there in the global markets. What happens is when things get a little rocky, people sell their assets, they sell their currency, they buy dollars, and then they buy the U.S. Treasury. But the other thing they also buy is gold. And at the end of the day, gold is not a consumable commodity. It's estimated that 98% of all gold ever mined is still in circulation, but it's generally thought, and it's been thought over the last 5,000 years, that when things get rocky, gold is a safe haven. Now, the other thing that gets me worried is the amount of government spending out there. We've been talking about this for a while, and what we call the debasement of the U.S. dollar, or will the U.S. dollar continue to be the reserve currency of the world? It's our thought that there's no other alternative in our lifetime right now, but you'll see that the more we continue to spend and spend beyond our means in the United States at the government level, the more our currency gets a little rocky. That's another reason our dollar has been lower. Gold provides a bit of a safe haven for that. And there's what we call a fear of missing out in the markets right now that has sprung gold to what we consider a 5,000-year high. Let's get to AI productivity. This is a chart done by Indeed. They come out with some pretty good data every so often. They went to a number of different Western European countries and Japan and asked them, how much are you using AI, or what does it save you? Either 0 hours, 1 to 2, 3 to 5, and 6 to 8 hours. You can see in the United States on the far right, excuse me, that 53% of respondents have said it's saved them 1 to 2 hours a day in productivity, 26 in 3 to 5 hours, and the rest 6 to 8 hours. So you can see it's not just capital investment in AI productivity. We're actually starting to get some on the other side, and there's good and bad there. The good things, it does lead to productivity and GDP growth. The tough side is going to replace some jobs out there, and people are going to need to be retrained to continue further employment. There was some doomsdayers out there saying, the country, the world, does subsidize our debt and buys our asset. But it's really interesting. You look at net foreign purchases of U.S. assets in 2024, as shown by the green bar, versus 2025, as shown by the orange bar. And you can see across the spectrum, with the exception of government agency bonds, despite what happened with tariffs et al., the world continues to see the United States as a great place to invest money, as our net foreign purchases of U.S. assets continue to rise, and that's a real positive. Now, let me touch here a little bit on, people are asking me, what do you think the market's going to do next year? And my general reaction is, well, our capital market assumptions probably do about 8% plus or minus 16. It's very, very difficult to forecast asset returns. As you can see, looking there in 2023, you'll see the analyst and the strategist right there have estimated something like that. And in reality, it comes out to the dark line. So if you look between 2015 and last year, you'll see that the estimates at the beginning of the year are nowhere near what markets actually do. So we don't spend a lot of our time trying to ask ourselves what the markets are going to do. It's a better use of our time to take assets away from those asset classes that don't offer very good risk return trade-offs and to point them towards some of the ideas I talked about earlier, where we think the risk return trade-offs are much more attractive. Looking at the market right now and Wall Street, it's going to tell you on the left side what different research analysts, and these are all good top high quality Wall Street firms, Oppenheimer, Deutsche Bank on the optimistic side, Ned Davis, Stifel Nicholas on the pessimistic side. You can see that it's all over the place. So we're not going to spend all that much time worrying about what the market's going to do next year. And even if you look on the right side, these are projections for the price of gold by the year end of 2026, anywhere from call it $5,500 an ounce to $3,500 an ounce. It's all over the place, and it's very, very difficult to predict. Now, what we're going to do next year to have some fun with this is we are going to undergo a change in our government. Mainly, we're going to probably get a new Fed chairman. And doing some really hard-hitting research, what we found is going back to 1979 that there's really a high correlation, believe it or not, between the height of the Fed chairman and interest rates. So you look back to the early 80s, Paul Volcker, he was 6'7". We had interest rates in and around 16%. He was replaced by Alan Greenspan, who was, we'll call it 5'12", almost 6 feet. Interest rates did come down quite a bit from the Volcker years. And then we hired over there, Ben Bernanke. He was a little shorter, about 5'7". Interest rates continued to come down. And then we had the petite Janet Yellen, which had interest rates in and around 1%. After Yellen came Powell. He was a little higher, again, about 6 feet. We've seen higher interest rates. Now we're trying to figure out who's going to be the next Fed chairman going forward. And we got a couple ideas here. So first of all, if it's that guy, he comes in at 7'1". And if in fact we hire Shaq as Fed chairman, that's not going to work out very well for financial assets. But we put a 50% probability on this guy over here, Yoda. He's about 2 foot. And then we'll get interest rates down from there. I don't know what this means. It doesn't really matter that much. So I thought we'd have some fun with that and bring back an old chart. But at that, let me kick it back to Caitlin, and we can have some questions, a time for some questions and comments.
Thanks, Mike. Appreciate that. The levity on the last chart was fun, so thank you for that. We'll go ahead and get into some questions. We do have a couple already, but if you want to
Great.
submit your questions as well, the email is up on the screen. Please email investment.team@trilogyfs.com, and I'll keep an eye on that inbox while I'm asking questions so we can make sure that we get to those. The first question, Mike, you talked early on about believing in American exceptionalism, and you showed another chart that shows how global investment in the US is still very strong. So what would have to happen for us to change our stance on American exceptionalism?
To move to abroad. Well, I'll tell you what, it's longer than one thing that's going to change our opinion. There's some things going on in Europe. If you spent some time over in Europe, you'll know. Number one is they're not having babies, and there's 3 ways to increase the size of your economy longer term. Is number one, you're going to need more people, which they are not doing. You have to get more productive, which they are doing. There's an adoption of AI. And then you have to work longer hours. And if you've ever been to Europe, they don't work anywhere near the hours as we do in the United States. This is still being found also in China, although India, their organic growth of their population continues to grow. That's good. There's still some things there, mainly corruption, that stops people from investing in Europe. So right now, shorter term, besides valuation, because European equities and emerging market equities at the beginning of last year were quite cheap versus the United States on a historical basis. There's can't see any catalyst right now for us to move a significant amount of money abroad. And one last thing I will challenge people is if you can name five great technology companies coming from those areas that have been formed over the last 5 or 6 years that are dominating their business. I can't name them. Maybe you can, but those companies are still coming from the United States.
Great. Thanks, Mike.
Mhm.
Question on kind of your last slide. You talked about the Federal Reserve and the Fed chair. So, kind of thinking more broadly, there's some questions around the administration's relationship with the Fed and the level of independence that the Fed has historically had. What kinds of near-term changes do we maybe anticipate there, especially given the new chairman, but also the current administration, and what might be the implications of that?
Well, if there's, a couple of things the administration I personally think is getting wrong is that the Fed should be an independent body. Now, the problem is the Fed chairman is nominated by the president, whoever that sitting president happens to be at the time. So the Fed chairman does have to kowtow to the administration a bit to keep their job. And what we're seeing is Powell really hasn't done that. I would like to see, and I think the market would like to see continued Fed independence. Let's just say we have a strong personality in the White House right now, whose obligation he sees to the American people is to keep interest rates low. And we would always like to keep interest rates low, assuming inflation isn't a problem. But what we're seeing right now is the Fed probably on hold now for up to 6 months. And we'll probably see a new Fed chairman in there. And if there's a bias to hawkish, being a Fed chairman that wants to raise rates and fight inflation, to dovish, a Fed chairman that wants to keep the economy growing, maybe at the expense of some inflation and keep rates low, it's probably going to be on the dovish side.
Keeping things in the political realm just a little bit, with the midterms coming up this fall, what are your thoughts on how that might affect the market, the economy, from a volatility perspective?
Yeah, history has told us that the incumbent in the executive, the party in the executive branch will lose at the midterms, and it will probably be much more on the Democratic front. You can see Trump's comments last week saying, hey, we need to start campaigning already. How will that affect the market? And, I hate to say this, but I like to say this, is you can't invest your money on politics. You have to invest your money on policies. And so it's more important to have the policies being somewhat pro-growth, pro-full employment, pro-low interest rates, anti-inflation, and that's going to dominate things much more than what party is in control of what part of the government.
All right. Thanks, Mike. Appreciate the insight on that one. It looks like there's a question around the credit card rates being capped.
Mhm.
So, from the perspective of investing in regional banks, what do we think in terms of what kind of implications that might have?
Boy, what a great question. And I worked on that this morning. I'm a big believer, first of all, of the free market and that interest rates should not be regulated by the government. Because when the government puts their hand in things, there's always unintended consequences. And people may disagree with me on this, but for instance, in one of my previous jobs, I spent a lot of time in Seattle. And when they artificially raised the minimum wage and they doubled it, if you walked into a McDonald's, you didn't order uh, into a person, you ordered into a kiosk. So that would be one of the unintended consequences there. An unintended consequence of capping um, credit card rates would be for poorer people who rely on that credit to live, for that to be cut off from them. Now, these rates can be considered usury. I saw that the average rate now is 23%, which I don't care what you say, that's pretty high rate, and you shouldn't be borrowing money, more than a month at 23%. But again, it's a good idea. I don't know how that's going to really pan out. The other thing people have been talking about is the amount of credit card debt out there, and that is true. But we have to look at what's rolling over. I don't know about you, but there aren't that many places right now where you can pay with cash. I was at a baseball game this summer, and I tried to get some cash for, some reasons, and nobody in the whole stadium took cash. Everything was credit cards. So if you think about that, we are going more and more towards a cashless society. How is that going to affect regional banks? It's probably going to affect the bigger banks more, the city groups. I don't want to give you names or anything, but the bigger banks like that who actually rely on credit card debt as a source of earnings growth more than the smaller banks.
It's interesting to see how we're moving kind of away from cash, but at the same time, you have the occasional business who wants to give you a discount for still using cash. So,
Absolutely.
um, all right. So we've got a couple of questions actually about silver specifically. We talked a
Yeah.
lot about gold. We've talked about it as a safe haven asset and kind of the fear that drives that. Um, do you think that it's a bubble? Do we think that it's sustainable? And with regard to all of the news about silver specifically, what kind of thoughts do you have there about what that means for us as investors?
Yeah, that's another good question because silver, unlike gold, is a consumable product. Silver is an input into a lot of things that we have, kind of like rare earths. So it's a little easier to judge where the price of silver would go. If you look at the price of gold, gold is worth what the last guy who bought it thinks it's worth. I mean, that's it. Silver, on the other hand, one of the reasons it has done very well is because markets look at the difference between gold prices and silver prices. Silver's kind of like a poor man's gold. And if gold's going up, markets over many, many years have said, well, silver should follow along, and it does follow along. Otherwise, there's what we call an arbitrage, as you buy cheap, sell expensive. And so that kind of keeps prices in line on a relative value basis. Are we in a bubble? I could say we're bubble-ish. We are looking hard at how this thing could run. Is there some, what the millennials call FOMO, fear of missing out? Absolutely, there's some fear of missing out there. Certainly don't want to be the last one in on the trade, which is why we are taking our time on this and looking at this longer term. However, when you look at silver mining, there hasn't been many silver mines opened over the last 10 or 15 years. So if there continues to be an increase in the demand for silver and the supply is continually constrained by the lack of product out there, this could have a bit more to go.
Thanks, Mike. We've got time for one more question, and we actually had a couple come in around crypto. So, in terms of as investors, the way that we run our portfolios, obviously, crypto is an interesting topic of discussion right now, and you see it in the news. Our administration seems to be bullish on it. So, what are your thoughts on Bitcoin, crypto as kind of a general investment asset?
I would say, and we don't have a view here on the price of crypto because it's even worse than gold when it comes to it's worth what the last person wants to pay for it. There's no way to value it. There's no underlying value. Buffett once said, if you were going to give me all the real estate in the United States or 20% of real estate, I would take that. If you're going to give me 20% or 50% of the stock market, I would take that. If you were going to give me 100% of the Bitcoin market, I wouldn't give you a dime for it. I'm not saying it's bad. I'm not saying it's not a diversifier. For those clients who want to hold some, sure, go out and spend, maybe 1% of your portfolio on the outside and buy the ETF. But it's very difficult over and above just looking at a chart to value these things. It's only worth something because somebody thinks it's worth something. Bitcoin's at the top because it probably has the best marketing of all the other cryptocurrencies out there. There's hundreds of cryptocurrencies out there. It's just a difficult one to understand at this point. I'm certainly, not saying don't do it because, a number of people have gotten very wealthy doing it. But what I'm saying is there's not a lot of fundamental support for where it's at any one time.
All right. Wonderful. Mike, thank you so much for sharing your reflections and thoughts today. To everyone who joined us, thank you so much for being here and thank you for your questions. Our next quarterly call is going to be on Monday, April 13th at 1:15 p.m. Pacific time. If you have any questions after our call today, please, we encourage you to reach out to your financial advisor at Trilogy. And if you don't have an advisor, please feel free to send an email to that investment.team inbox and we'll get you connected with someone. Thank you very much and enjoy your day.
Thank you.